Hey Neil, how you doing, man? Can you hear me?
I can. How you doing, Adam? You okay?
I'm good, thank you. How are you?
Yeah, very good, thank you.
Good, good. What's this picture behind you?
That is something my dad's secretary actually painted that.
What? It's not Simona then.
It looks like Simona, but, it's not. It's not actually Simona. No, it's something she painted for us.
Your dad's secretary painted it, right? Okay.
Yeah.
There's a story to that. Let me look at my
camera. Bit of an
camera.
artist in a spare time. So she's done a few for us actually.
It's quite a talking point, isn't it?
Yeah, it's good. It's all good.
I wonder if it's like, I always wonder when people put things behind themselves, if it's intentional, you know, like if it's like because where you choose to position yourself is obviously normally quite intentional, you know, with the video.
I know, it's like the only clean bit of our dining room at the moment, so that's why I'm sat here always.
Fair play.
How's life back in London?
Actually, really busy. Yeah. Like just loads of things I sort of hadn't done when I was away, obviously.
Yeah.
And you know, just me going full guns blazing into it. So, but it's actually really good. You know, lockdown is lifted effectively, and I had some family over on yesterday. Because obviously they can come over now, can't they, and stuff, come to the garden. So
yeah,
that was really nice.
Stuff. Excellent.
Yeah, it's a bit mental with Capital Living at the moment because we're moving office. So
yeah, you mentioned that on Friday, didn't you? That you're moving.
Yeah, so it's like trying to make the most of this time now where we've got like lockdown lifted, but we're not at full speed.
Yeah.
So yeah, so that's kind of like trying to make the most of that. What about you? What's going on with the business?
Yeah, it's all okay. So obviously all of our portfolio is student market, but that's really, I mean, we rented out our houses back in October actually for the next academic year, and they're all going well. And actually, what happens sometimes during recessions and economic downturns is actually student demand goes up because a lot of students decide to stay on and do master's degrees. So some of our final year students this week actually have got in touch with us to see if we've got anything available, because that's exactly what they're doing actually.
They just stay in education because there's no point coming out.
Staying on, exactly, because the jobs market's going to be so poor now for the next year or 18 months.
Yeah.
So it just makes sense for them. So yeah, we've been quite lucky really, and both the universities in Leicester are opening in October, so a couple of weeks later than planned. But
I'm so pleased for you. That's good, because I haven't actually heard. I've only heard, you know, in the board and in the group, people who are struggling. Obviously, you don't hear about the people that are doing okay or better. So
yeah, so thank you. Yeah, it's we've been quite fortunate really with that.
But equally, like, you've got a good product and you were oversubscribed, you'd already sold it, so it's kind of like, you know, you just happen to be at that stage in your business where you've got the, you know, the house didn't need refurbing and you were getting.
Yeah, exactly. They're all new and you know, in good condition and
yeah,
in high demand.
Yeah. So, nice. Yeah, good stuff. How's everyone else doing? Who else have we got on here? Got Ocean. I haven't spoken to you in ages, Ocean. How are you, man?
Yeah, I'm not too bad, thank you, Adam. Yourself?
Yeah, pretty good. Looking dapper in your photo. Looking nice. That's the Belfry, isn't it?
It is, mate. Yeah, straight after I got the awards, yeah.
Yeah. Oh, I couldn't see the award. Oh, yeah. Sorry. Yeah, very nice. Very, very nice. How's business? Is it bounced back for you? Are you inundated or is it slow?
It's slow. It's picking up though, to be fair. It's like yeah, just warming up to get going again now. So yeah.
Good. That's what we like to hear.
Morning.
Sorry.
Thanks you.
How you guys doing?
Yeah, very good, thank you.
Yeah, I love this picture behind you, man.
Yeah, Adam was just saying actually. Yeah, Simone pretends it's her, but it's not really.
Just make it her, man.
It's such a talking point, isn't it? It's like, it's very provocative. It's not just like any photo. It's kind of a low cut dress. It's it's risque. Loving it.
Amazing picture.
Loving it.
Adam, are you back now, man?
I'm back, Leo. Where were you on Friday?
I was in Cambridge, man. I was in Tree Chalet.
You know what? Sorry.
Tree Chalet. So I rented this chalet on is a forest just outside Cambridge.
Right. Okay.
And this person I know, so what he did was he's the owner of the whole land, and he built these chalets on trees.
Very nice.
And I just rang him up, and I had to do a few things around Cambridge, so I just stayed there for a few days. So yeah, I missed the call, man. I missed the call.
No worries. Well, you know, I'll let you off because you've always been pretty much the first one to every single call. So
I'm glad.
Keen, Lee, I'm liking your new office as well.
Checking the
Oh,
sorry.
That's all right. It's okay, Mina. You're right. You chipping in there?
Yeah, just saying, don't forget your check-in stuff as well. I was saying to Leo and Stuart, midweek check-in.
Your midweek check-in, yeah?
Get on there after this call.
Yeah, you want to get on there, guys. Vina's posted a nice little video, and you want to show us some support and see where we're doing.
Yeah, that's actually in the front of my house, Adam, not my cave time.
Oh, it's beautiful.
Yeah, I live in a maisonette part of a Victorian properties. There's 3 flats, and we have the top 2 floors.
Very nice. Yeah, well, it looks absolutely stunning. So I am a big fan of Bristol, and Bristol was obviously mentioned as one of those cities, wasn't it? Those cities that
it was indeed. That's
really going to be a good place to live. That's great quality of living. I think, you know, those sort of little Londons, they're called, like the Winchester's one, you know, anything within like an hour and a half, 2 hours of London, you sort of get that Oxford, you know, you get these lovely vibes that quite cosmopolitan without the overhead. So
absolutely, I love living in Bristol. It's a great city.
Good. Yeah, well, honestly, I think it's definitely on my list. I've got a friend who lives in Clifton. It's beautiful.
Yeah, I'm not far from Clifton at all. I live just around literally just around the corner from the Downs.
Okay, cool.
So
nice.
That's great. Are you glad to be back in London?
It's good to be back. Yeah, it's really good to be back. It's busy. There's things going on. There's things I haven't done that I'm sorting out. The novelty will probably wear off pretty soon, I imagine. But I mean, London is just, you know, Clapham Common, Wandsworth Common. Every morning when I go for my walk, it's like rubbish everywhere because it's been packed the night before. Everyone's partying. And in East London, my sister said behind her flat they closed down a 1,000-person illegal rave at the weekend.
Wow!
So people are definitely getting back on it. So yeah, there's no shortage of fun. So I'm just going to see if Simon's joined us. Yeah, Simon's on. Okay, perfect, cool. So ladies and gents, we'll get cracking. So welcome to Survival Training. Obviously, I missed last week because I was repatriating back to the UK. So it's good to be back. It's good to be catching up with all of you and sort of following on from Dan's sentiment. Really, definitely is back to business now. There really is. We are starting to see the shoots. Like even Ocean was saying, you know, he's starting to get busier. We did one sale. We did one room sale the first week. We did 2 sales last week. You know, so I'm hoping we do 3 sales this week, and the sort of curve that we predicted at Property Entrepreneur is going to happen nicely. But today's not about that. Today we've got a special guest, and it's, you know, in these uncertain times, it's all about educating ourselves and staying ahead of the curve. And, you know, I've obviously run my own company now for about 15 years. So I've got a little bit of experience with my responsibilities as a director and how best to extract money from businesses and how to always stay on the right side of the law and the responsibilities. Because I think the key sentiment with this is we're not taught this. We can sign up to be a company director and be in business with very little training or sort of credentials or anything like that. And ultimately, we have quite a lot of responsibilities and obligations. So it's a very important subject, and one that I'm really glad we managed to get Simon to come and sort of educate us and share his experiences and answer some questions about this in these times, you know. So I think the key sentiment for me is something that Dan said, is like, don't leave breadcrumbs. So what do we mean by don't leave crumbs? I think he said. What do we mean by don't leave crumbs? It's like, don't leave like loose ends. Don't leave things behind you. You know, if you're going to do something, a property entrepreneur, we want you to do it properly. This isn't, we don't do half measures. We want to be neat, tidy, and move on. And you know, that That obviously includes knowing your responsibilities and making sure that you keep the right records and everything else that you need to do to protect yourself, to protect your business. So that's the first thing, is like, this is definitely a building on our mantra of don't leave any crumbs. The second thing I think with this is that, like I said, this is much more now an educational piece and a chance to ask questions. And there is no such thing as a stupid question, because I would imagine that most people's knowledge is very, very entry level. So I'm just going to put that out there right now. Like, if there is any question, I really want you to encourage to answer it. There is no such thing as a stupid question. The goal as well is not to like scare the shit out of people. This is not like, definitely not a fear building thing. So even though Simon is a solicitor, you know, this isn't going to be like this is not the goal of the session. This is to educate people. And the third thing really is about, we talk about a lot of property entrepreneur about like financial fortress, and you know, financial fortress means that being absolutely bulletproof. And the time you get tested, you know, you build your fortress in the good times, but obviously it comes under fire during war, right? And that, we're in war. This is the war room. So we get to test our fortress now. So, you know, perhaps they're not quite at the gates yet, and perhaps you can put the finishing touches on your fortress. And certainly financially, that means like what you're personally liable for and not liable for, especially with all these loans we're getting and things like that. So you want to make sure it really is a fortress and it really has a moat, and these things are bloody difficult to breach, and it's not just a fence that you thought was a fortress and it blows over in the wind. So yeah, they're my sort of three key sentiments. So like I said, Simon is he's a partner at BP Collins. He's actually an award-winning, like we'd call him a commercial lawyer, right? So there's lots of different aspects of law, but Simon specifically focuses in business. And specifically within that, he focuses on commercial law, insolvency and asset recovery, as well as like shareholder disputes. So basically when things kind of go ugly, it's kind of normally when you need to bring the solicitors in. And he sees all that side of things. He's got a really unique viewpoint of where directors slip up, where they go wrong inadvertently, where business partners fall out. And so he has a really unique insight into that area of business, which is a key part of our Entrepreneur's Toolkit for sure. So I'm really excited to welcome Simon. So Simon, just checking that you are with us. If you could unmute yourself, please.
Yes, I'm here.
How are we doing?
Yeah, all good, thank you. It's yeah, great to be on. Thank you for having me.
No worries. I know you're incredibly busy, because obviously, sadly, these times are, you know, presumably when people like you get a bit busier. So I just want to thank you for taking time out of your busy schedule, because, you know, for those people that have seen Suits, I'm sure you work similar hours, right? So, well, you're not wearing a suit today. So.
Yes, it's identical to Suits. No, look, thank you for having me, and thank you all for listening. The aim, I think, of my coming on and having a chat with you all today is to give you a bit of framework around what happens when things go wrong. And, you know, obviously we're not in this to look at worst case scenarios, but the idea is so that you all have a bit of perspective about what the big potential bumps in the road could look like, so that you can take steps to avoid them before they happen. And as Adam says, my background, I'm a solicitor. I'm a solicitor advocate specifically, and I spend quite a lot of time dealing with disputes in court, and that often involves things like shareholder fallouts, disputes between directors, bust-ups over contracts, and representing directors when they are being disqualified. So all those things are really worst case scenarios. And as Adam says,
sorry to interrupt, just on the basics level, what is an advocate?
An advocate is someone who goes to court and actually stands up and represents somebody on behalf of a client. So I would be the person that stands up and talks in court.
Perfect, thank you.
What I'm hoping to do is is run through a bit of a presentation and talk to you for 25 minutes or so. Feel free to jump in with questions, but I think afterwards there'll be lots of scope for you to throw any questions you have at me. I'll do my best to answer anything that you have, but we'll have to see what you say.
Well, I'm sure there'll be lots of questions about these bounce back loans and civil loans and things like that, but we'll come on to that later. You should be able to screen share, so
yeah, so
I've got something prepared. Yeah.
Bear with me. Let's just sort this out.
And ladies and gents, as always, like any questions, post them in the chat. I'll field them to Simon at the end. And it is obviously, you know, we're a closed community, so I'll ask the questions you want to ask. No such thing as a stupid question.
So can you all see the screen that I've got up? It should be a picture of a very satisfied coffee drinker with a title, Considerations for Directors. I can see some smiles, so apologies for the poor humour. So yeah, you've got my firm there, BP Collins. As Adam says, I'm a partner in the dispute resolution team. I'm not going to sort of talk about my background lots because I think it's really more relevant for you guys if we just crack on and talk about some of the specifics. Save to say that because I see things from a bit of a worst case scenario, it can be quite helpful to talk about sort of what we can do at the grassroots to try and make all these problems not happen at all, because that's really the game plan here. The overview, just what I'm going to run through briefly, we're not going to go into lots and lots of detail, but we're going to talk about the rule book. Now, you'll probably have heard phrases like director's duties and things like that. This is really the starting point. There are some duties that are enshrined in law, in statute, that are supposed to give you some guidance as directors of companies, or as they don't specifically apply if you're sole traders, but the point is you should be thinking about those when you're running your businesses. I'm going to talk briefly about the insolvency and sort of powers of liquidators. This is really what happens when companies go into difficult periods of trading or when they go insolvent, what you as business people need to know. I'll touch briefly on disqualification. This is when directors are effectively struck off because they don't maintain the standards. It's not something that I think is made clear enough for incoming directors, but it's worth you knowing that it exists as a concept, just so that you can sort of flag up issues and know when to ask further questions if you're concerned. And then we'll touch on a bit of practical guidance, and there'll be lots of scope for you to ask questions. Now, let's run through this. I don't know if you can see some of the notes that I have on the bottom of my screen, but just let's focus on the main screen there. These are the core director's duties, and they're enshrined in the Companies Act 2006, which is a very dull piece of legislation for most people, but for people in my job, they can be exciting. Acting within powers. People don't often think about the company's articles. When you set up your business, there are a number of rules that sort of govern how decisions are made. When we are looking at what decisions to make, often there's not a lot of thought given to whether or not we're saying, okay, how does the company's rule book say we should make decisions? Is there a requirement for a board minute? Should there be meeting minutes? What decisions can I make as one or one of two directors? So the point here is think about the powers that you have and try not to step outside them. In terms of promoting the success of the company, this is probably the most important one for any director at this moment in time and any other moment in time, frankly. You as a director or you as someone in charge of a business have a duty to promote the company's success. Now, what does that mean? Well, courts usually say, well, it means for the benefit of the shareholders, you have to try and grow the company, you have to try and make it successful. And it's worth noting that when we act or when we work in a business, we all wear different hats. On the one hand, you might be wearing your director hat, and in that capacity, you're in charge of the business. You make decisions on behalf of the board, if there is a board, on what the company does, but you're doing it for the benefit of the shareholders. And you could have someone who's also a director as well as being a shareholder. But in those capacities, they have different responsibilities. The shareholders are the silent investors. They don't openly have a say in what the business does. And they can't say, you, the director, must do this or must do that. They are there to collect any dividends, to sort of reap the benefits of the company's successful performance. If they all get together, then they can ask that the directors do certain things, but I don't, for the purpose of today's talk, I just want to make the point that there are different responsibilities. There may also be hats that we wear in our capacities as employees. There might be a director service contract that says, this is how much we'll get paid and when. Or there might be other employees of the business that have employment contracts that we need to think about.
Yeah, Simon, that's really interesting, man. Sorry to interrupt. I think
no.
So most people listening will be an employee, a director, and a shareholder. Some will have business, some will have partners, some will have businesses a little bit bigger than that, but most will probably be wearing at least two of the hats, if not three.
Yeah.
So I think that's worth noting. So, like, with this sort of promote the success of the company, is the purpose of a company to make money for the shareholders? Is that the purpose of a company?
That is exactly the purpose of the company. The reason this is important is because when the business is trading and doing well, it's making money and the shareholders are happy, and we're taking money out of the business, and we can talk about the mechanics of that in a little bit. But we just need to be aware that we are wearing different hats when that's happening. And that becomes important because if the business starts to do less well, maybe we're struggling with cash flow, maybe there's sort of difficulties with the balance sheet or maybe whatever, and we start thinking, okay, it looks like there's a solvency problem here. Now, at that point, the law says your duty to earn as much money as you can for the shareholders switches to one that says you've got to maximize, you've got to prioritize the company's assets for the benefit of the creditors. So anyone the company owes money to, you've got to say, okay, I might be a director and I might also be a shareholder. And yesterday I was thinking about how I could grow this business because that's part of my investment plan or my business plan or whatever there is. And that's for the benefit of me and my capacity as a shareholder. Suddenly you have to think, oh, what is in the best interests of Joe Bloggs, the creditor, the supplier who's gone unpaid, the bank who's got a charge. And if you're aware that that's when the obligation starts to move, you get into far less difficulty. The big problems I see are when people don't know that they actually have multiple hats. They don't know that there's a distinction between being a shareholder and a director. And some of you this may be telling you to suck eggs. So my apologies.
No, honestly, I think it's a really good thing. So just pick up on a couple of points. So
yeah,
when a company isn't solvent, guys and girls, that's obviously when it can't meet its obligations. There's a few tests for solvency, but that's what Simon's sort of referring to. And obviously creditors being people you owe money to. So where you are director and shareholder, if Capital Living suddenly can't pay its landlord rents every month, then at that stage, effectively, I could be insolvent. And at that stage, then I'm now much more, the money that's in the bank has to be distributed to those landlords potentially evenly or however, but and therefore not to the shareholders, because as a director I'm now the arbiter of those funds, those assets. That's my duty as a director, right? So is that right, Simon?
Yeah. And it becomes relevant because if everything goes wrong and the company it ends up going into liquidation, where there have been, let's call them breaches of the director's duties, will be looked at by a liquidator. And
who is a liquidator, Simon?
A liquidator is someone who comes in and takes control of a company that has gone insolvent. So if let's say a supplier gets bored of waiting for payment and they decide to petition to have the company wound up, they say, look, I don't believe you can pay this. It's been outstanding for months and months and months. I'm going to ask the court to wind up this company. Now, there are lots of ways this can happen, but if we assume that happens, then another party, usually an insolvency practitioner, a professional person, will come on, will take hold of the company. They'll get all of the company's assets together. They'll say, right, is this solvent? Is it insolvent? If it's insolvent, then they will look at what assets they can get in for the benefit of the company's pot, which they'll use to pay out the creditors. And in that process, they will look at instances when there have been breaches of directors' duties, and they can use that to try and claw back money from directors personally. Now, this is the big red flag. And if there's one takeaway point here from all of today, I think it's be aware that there are means by which you can become personally liable if businesses are in serious financial difficulty. And I do go back to what Adam said. This is not, the intention of this is not to scare people. It's to make you all aware that if you start getting into concern with particularly cash flow, it's very good to just pause and talk to someone, because at that point, you're at a crossroads and you can go one way and improve your odds dramatically, or you can go another and it all starts to unravel. And what we want to do is avoid all this unraveling.
Great advice. Thank you, Simon.
I'm just going to whiz through the rest of these. Exercising independent judgment is about making sure you're not effectively biased. You're exercising your own decisions as custodians of the company. You are the directors, you are the ones in charge. There are some interesting examples of very, very active shareholders in the press. I don't know if any of you have followed EasyJet. Adam might have heard this one already, or you might have picked it up on the news, but that's a well-known low-cost airline. One of its majority shareholders is a very, very wealthy individual who's not a director. And he has made his very, very public concerns expressed in newspapers about whether or not there should be a continuation of the company's existing contract to buy more planes. So he's saying in the press, if you don't do this, I'm going to call a meeting with the intention of firing the directors one by one until you listen to what I'm going to do. Now, that's a very, very extreme example. But if the directors were to say, okay, I'm going to do what this guy wants because he's a majority shareholder, and I'm not going to think about what's best for the company, then that's a nice example of not exercising independent judgment.
Very good.
Exercising reasonable care and skill and diligence. This is not something I want to spend long on, but when the courts look at situations where there have been decisions made by directors that are questionable, they look at whether or not they've exercised the required level of care, skill, and diligence. I don't know if you can see these pop-ups. I'm sorry if you can.
Can't see the pop-ups. You're good. Honestly, you're good to go.
Okay. The point here is that if, courts look at usually you with the experience you have. If you are, say, a business consultant with 50 years experience of running companies, then in all likelihood, the bar against which you're measured is going to be higher. If you are a new director straight out the gate without significant experience, then you're not going to be measured against the same bar. But equally, it's worth knowing that if you're someone who's not of that level of experience, you're going to want to be able to say, look, I recognize that I've got less experience and I've done responsible things like take advice from third parties, whether it's a financial advisor, an accountant, a lawyer, or whoever. Avoiding conflicts of interest probably seems like an obvious one, but it often comes up when we're dealing with payments of money that are made by the company to directors or to their families or to their friends. Often what happens with new businesses is there's some seed capital or a loan that's invested, and sometimes that comes from connected parties. Sometimes it comes from family, sometimes it comes from your personal coffers. We need to be a little bit careful when companies get into a position where they're struggling with cash flow. Lots of directors think, yikes, got to get my money out. And they pay it straight out to themselves. Those sorts of decisions are often challenged by courts later down the line, and they can lead to all that money being paid back. So when we look at how you get your money out, I think it's good to try and have a structured plan in place, because you don't want to be in a position where there's lots of capital left in the business that you're concerned to get out if you haven't sort of thought about the risk that you might not be able to get it and you're comfortable with it. What you don't want to do is be making cash grabs at the last minute, because it's a very, very obvious way for problems to happen.
And that's exactly why we've got to be prepared in this situation, because by the time it's too late, and you'll be making you'll be under stress, you'll be under pressure, you'll be making emotional decisions, and you'll make knee-jerk reactions that could really screw you up. I heard an interesting story from my accountant. We were talking about this a couple of weeks ago, and he said that he was the financial controller for a business. I can't remember what the business did, but it was quite a successful business, and it was clearly going under. And the director told him, he said, we're insolvent. The director said, I want you to pay me a dividend now of 6 million. And he drove to Marbella that night, right? So this guy, I mean, you could not, it's literally like the classic thing, like you just couldn't imagine, in his Ferrari, right? So you're kind of like, this is the classic thing of what not to do. But the moral of the story was, obviously you can't do this, but this guy actually ended up getting in trouble, like you said, having to repay the money, but then before he could repay the money or while it was going on, he actually crashed his Ferrari, and I think maybe even had a very serious accident. My accountant didn't say, but I think we did a session on karma credits last week, and it feels like the universe kind of got its own back there. So yeah, anyway, an interesting story.
Yeah, well, it goes to show, doesn't it? Ferraris, eh?
Ferraris and Marbella. You can't make
Ferraris and Marbella. What are you going to do? Well, look, just to finish on this, accepting benefits from third parties and declaring interests. Declaring interests is really connected with conflicts of interest. If you are a director of a company, you want that company to enter into a contract with another company of which you're also a director. You have an interest on both sides. So it's important that you declare those interests. You can often deal with that by minuting what's going on. So recording in a board minute that there is an interest that you have, the company understands it, you've declared it, everyone's happy with it. When we look at the specifics of those, you often want to go into a bit more detail, but if you don't declare it, it looks questionable, and it's something that can be picked up. Accepting benefits from third parties probably doesn't apply, but it's things like bribes. Giving a contract to a particular supplier or taking a property from a particular landlord in relation to an obvious benefit that you as the director personally get rather than the company who is entering into the contract. So just things to watch out for. I'm going to skip on to the next slide here. We've touched on this already, but why is this important? Well, we're trying to make sure that you all don't end up being hauled through the courts, and there are some fairly clear things that you can do. Simply knowing about the possibility is a big first step. But this is important. I'm telling you all this because going back to when we talk about wearing different hats, the company itself is a separate legal entity. So often people think, well, I've set up my business. Yes, it's a company, it's incorporated for tax purposes, but really it's mine. I'm the shareholder, I'm the director. And sometimes what's forgotten is that you've created something that has its own rights. And when you're acting as a director, you have to be thinking consciously, what is in the best interests of this company, rather than what is in the best interests of me. And that might sound like an obvious distinction, but it's worth bearing it in mind, because if there's a problem, the company has the ability to then come after the director for repayment. And it's quite a shock in some instances, because sometimes as a director you will go and take professional advice. You say, look, I'm having difficulty with cash flow, and you might talk to an accountant or a financial advisor, and they'll say, okay, well, let's manage the creditor risk. Let's look at payment holidays and all that sort of stuff. But if it doesn't work and you end up saying, okay, I've got no alternative here but for the company to go into an insolvency process, they will then, the same financial advisor might turn around and say, okay, well, I think you need to repay the company. And some directors think, oh, yikes, I didn't see this coming. Where's this coming from? But actually, that's the nature of the situation. So just to bear in mind that there are these two competing rights at play. And this doesn't have to be a problem. It's just important that everyone's aware of it.
I think, Simon, on that, I think, honestly, like, for me, this penny didn't drop for quite a long time. I always just saw in fact, I'll tell you where this was obvious. When I was doing my personal balance sheet, I'm a property entrepreneur, we teach, personal cash flow management, and we do our assets and liabilities for our personal as well as our business. Certainly at like the board level we do. And I always used to include my business cash on my personal balance sheet. And in my head, I just always saw it as my wealth. But of course, it really isn't your wealth as a director, it's your business's wealth. And you only really have, your wealth is only really stuff that's in your own name. And this penny maybe is dropping for a few people who are listening. And it's very, very important, because this is where you get caught out, because you, like you said, it's literally a lack of understanding that you could go to this accountant and think you're going to get some money out, and actually you've got directors' loans because that's how you've been paying yourself, and you just think that's fine because it's your business. And then actually, no, these directors' loans now, they're not formalised and they can be recalled at any moment. And actually, as a director, you should recall it from yourself. That's right. That's what you were saying, wasn't it?
It's an alien concept for a lot of people, because you're right. It's very easy to think this is my creation, this is my business, and why should someone say that this money is not mine because I've earned it, and there's no distinction. But actually there is, and it's why it's so important to think about how we take our personal funds out of the business in the right way.
And I know you're going to come on to that in a minute, but I think the other thing about this is key is that, and I think I saw it in your notes, is that you can't treat your business like your personal piggy bank, because a lot of us won't draw money out, and I'm really interested to hear how we should draw money out. I'm sure it's later in the presentation and how it should be done properly. But for those of us that don't, because we want to keep it in a low tax environment, we want to run it, you also do need to be very careful about running expenses through, you know, you need to make sure you've got a justification for everything, because I presume that's where also people get caught up, is it?
Yeah, I often have some very interesting conversations.
Can you give us some examples of things
with directors? Well, you know, let's say you're in a situation where unfortunately your business has gone under. There is a big outstanding loan that you as a director have taken from the business, and you know that's all minuted in Sage software usually. You know, so it all gets whacked into a great big spreadsheet, and maybe the liquidator sent you a letter that says, right, this is all repayable, can we have it back? And director comes to me and says, how do I not have to repay this? And we go through it all, and I'm looking at the itemized breakdowns. So right, what's this, you know, payment of £2,800? Oh, that's for my car insurance. I'm like, okay, I mean, is this a business car? No, it's my Aston Martin or whatever it is. What's this? Oh, it's my servicing cost, or oh, it's my daughter's school fees. And all of these expenses, you say, well, help me understand how on earth that can be an expense of the business. How does this have anything to do with, I don't know, a film production company, whatever it might be? And the answer is it doesn't. And it's very, very hard for somebody in my position to then say, okay, this is a justifiable expense, or actually, this shouldn't be reclaimed, or we should ask the courts to grant permission for this expense to be incurred at a point in time when the company is insolvent, because it needs the expense in order to keep trading. And what you don't want to be in a position is for the penny to drop at that point. It's far better, as Adam says, that you'll sort of get a bit of perspective now, because it helps when you start structuring things. Perspective
and advice, you know, there's nothing, like Dan and I are very vocal. We run a lot of expenses through our businesses, but we know that we've taken tax advice on it and that we've got a very credible reason why, you know. So I think that's, again, it's not saying don't do it, it's just... Oh, absolutely. It's not saying don't do it. It's saying understand the process. And when you do know it, when you do it, you know that they will need to be repaid. And there's a plan in place for that to be repaid. Yeah. Cool. Thank you. Let's jump on. I think we've touched on this. This is the scary stuff, really. You know, these are examples of how the worst case scenario hits, and the only reason we're going to run through them is just to give you a bit of a flavour of the red flags. So the trading in financial difficulty versus insolvency. I touched on this when we talked about directors' duties. The duty that you as directors have when the business gets to a point when it's either definitely cash flow insolvent, or its cash flow is looking pretty difficult. You're stretched meeting the day-to-day obligations. Your obligation as directors then effectively switches from one owed to your own shareholders, maybe that's you personally, or to one owed to your creditors. So the big I think piece of advice here is don't at this point start making lots and lots of payments, particularly to yourself, without sort of thinking them through. If there's a loan that the company has to, you know, Graintarm, Neris or whatever, you know, don't think that now is the appropriate time to repay it. You might well repay it, but the liquidators could easily go after her, or they could go after you, even though you don't have the money, on the basis that you effectively caused the company to be in a worse position for the creditors than you would have been had you left things as they were. Could you just say that again, Simon? So if if you say that someone else's loan can be paid back, but it was the wrong thing to do, you could personally be liable for that loan. Yeah. The money didn't go to you. Yeah.
let's say, in all likelihood, a claim would be made to your great aunt, but let's say she jumped in her Ferrari and driven off to Marbella and they couldn't find her. They'd come after you, and even though you don't have the benefit of the money, you'd still have to make the company whole. So that those sorts of things are the big red flags, and as I say, those are the things that I see lots of. Yikes, the company's in difficulty, I better repay my loans, and it all causes problems. I've talked a bit about the duty owed to creditors and the risk of personal liability. There are, I should say, lots of ways that this can happen. And I think if I start at the bottom, PGs are personal guarantees. And we often see this becoming an issue because if we're a new company, we've borrowed money from the bank. The bank said, yep, I love your idea, here's the cash, but I don't love it enough to lend it to you without some sort of guarantee from you personally. And that guarantee often sits there for a particular period of time. Now, many directors just assume that after 5 or 6 or 10 years of trading, the guarantee ceases to have effect. But actually, it will never be withdrawn unless it's actively taken away. So you need to get those guarantees removed if there is scope for them to be removed. You usually need, if we're dealing with a bank, you need their permission. And sometimes it can come as a shock to directors who suddenly find that there's still a guarantee in existence. And when the company is in difficulty, let's say it doesn't meet its monthly repayment, the bank might say, right, I'm a bit concerned that you're talking to advisors and that you say you can't meet your obligations. We're calling in this loan. That has an impact for the company because it's a big chunk of money that's then payable immediately, but it's also going to have an impact for you as a guarantor, because as soon as the company doesn't pay, let's say the bank then has a direct line of recovery against you. And we don't even have to think about involvement of liquidators or anyone else. It's just a very straightforward process that can happen very quickly. So if you do have any personal guarantees, they're a necessary evil.
I think the personal guarantee one will probably be of interest to a lot of our property entrepreneurs, because inevitably you have to put PGs down for a lot of things. Yeah. And I think people know that I recently, well, not recently, but over the last few years, I've been using crowdfunding as a debt facility for capital living. And I'll share with you now, that I had to put a PG down for that loan. Well, obviously we're going into like troubled waters, and we work on the mantra, don't bail out the boat with your own bucket. So one of the things I've looked to do is pay back loans with my personal guarantee. I've done it and I've taken advice on it, and I've done it before the business has got into financial difficulty or an insolvency position. So I've been able to do it. And I think the key sentiment here is you are able. It's not to say you cannot pay back your personal guarantee loans if you've got some now that you're worried about, but it's to say that if you leave it until the last minute or when the business is in trouble, then no, you probably won't be able to. So again, preparation is everything. Planning is everything with this. But the PG thing is as simple as that. For those people that don't understand what a personal guarantee is, it's like Simon said. Isn't that right, Simon? They will just switch to you. There is no. It's so matter of fact. We can't get it. We're going to go after you, and it's everything you own is on the line, including your house, right? So. Yeah,
and it's difficult because you can't use the company's funds to fight your own personal battle because there's the conflict of interest, and if the company ends up in difficulty, the company ends up suing you for that money back, and it all spirals. So yeah, you're right. Prevention is certainly better than cure. Yeah. And I'm quite alive, by the way, to the fact that you're probably listening to this thinking, well, I've got this business to run. I've got all these commercial issues going on. We've got the economy doing what it's doing. We've got the government introducing all sorts of schemes that I'm having to think about. How on earth am I supposed to get on top of that and understand this? And the answer is it's not straightforward. And I think you're probably right to ask that question. But the aim of today and what I hope you take from this is that even just knowing where these issues look like they're arising is going to help. If all you get is a steer toward where the red flags are, that's going to help you significantly, because it will point you in the direction of saying, okay, I think there's a bump on the horizon. Let me talk about that with someone, and we can navigate our way through.
Exactly. Does that lead on to misfeasance then? Is that a similar? Yes,
misfeasance is a general term that's used to describe a number of offences. I call them offences because that's how they're termed in the statute book. But it's circumstances where directors usually act in a way that cause the company loss. And this is important only because you'll have heard possibly in the press about some discussions about the temporary suspension of wrongful trading mechanisms. Liquidators and insolvency practitioners have certain powers, and when directors trade fraudulently, and that means that if you know a business is insolvent and can't pay its debts and deliberately rack up lots and lots of debts for the company that cause it to go into a significant insolvent situation. And I should say I'm paraphrasing quite a lot here because.
So what would be an example of that, Simon? Just to give it like a.
Well.
How would a company rack up lots of debts?
Well, if I'm a business and I know that I've got no pipeline at all for the next 6 months because I can't do, let's say I need a license to do whatever it is I need to do, and that's just been refused. Maybe it's HMRC, maybe it's something else, but I can't actually do the business. I keep taking on obligations to suppliers, so I keep buying things in to the business and saying, yeah, I'll pay you for them, but actually I know the company's got no money to pay and it's got no ability to keep paying because we're not doing any work. The fact that I know that that's the position, and I know that the company is definitely not going to avoid insolvency now because it's all over. I'm just sort of perpetuating an insolvent company. Then we're in the territory of trading fraudulently. I'm deliberately misrepresenting what's going on to the world at large. And those circumstances do carry some quite serious risks for directors. There can be monetary claims, you can be sued for money, and in the worst cases, you can go to prison. Now, I don't suggest that this is a realistic concern for a lot of you. We're talking about real criminal activity here. What does happen quite a lot is wrongful trading. That's when you get the same sort of situation, but without the intention. So, it might be that actually, if an accountant looks at your books, they'd say, yeah, mate, you're definitely insolvent here. But you as a director, maybe you haven't picked it up, or you think, well, perhaps you're over enthusiastic about how the company might perform, and you keep trading, keep taking on those liabilities. Maybe you think, I know that license has been taken away, but I'm really sure it will be handed back in 6 months. And anyone looking into the company looks at it and thinks, I don't think you're onto a winner there, mate. Now that's broadly wrongful trading. The same sort of implication, but it's not done with intention. Now, the government has made lots of statements about how this would be suspended. And there was a very, very long bill, so a draft piece of legislation that's currently going before Parliament that suggests that there will be a suspension of that provision. So that would mean that directors don't need to worry about it. I'm only mentioning this because in practical terms, it's going to make absolutely no difference. The ability to go after a director to recover money under wrongful trading almost completely exists under what's called the misfeasance, the general breaches of directors' duties. So it's not going to make a huge amount of difference. So the only reason I'm saying this is because you might have heard in the press that there's lots of scope for reducing the risk for directors. It's great politics, it's great news, but it doesn't actually mean anything. That's generally where we get to.
That's really good to hear. Thank you for clarifying that, because I think that's such value.
Yeah, you probably think great, valuable, but not great news.
Potentially, yes, but I think the key sentiment here is, when you think if you're sailing on the ocean and you go from, clear skies and calm sea, and it starts to get choppy, that the advice is pause and get advice. It's
exactly.
That's the advice. Is not don't fight this by yourself and think you can't ask for help, because you can. And
okay. So let's move on. Now, reviewable transactions, disqualification risk. I'll tell you what I'm not going to do. I'm not going to drown you in detail here. What we've talked about in terms of what things can be recovered from directors, these are the main mechanisms by which that happens. And what a liquidator could do, someone who comes in and takes control of the company, is say, right, what's happened in the last, let's say, 6 months? If you as a director have said, okay, company's got an asset, it's a van, it's worth 20 grand, I'm going to sell it to Aunt Meris for 200 quid, then that's a transaction at an undervalue. Company's got 200 quid in relation to an asset which it should have got 20k. So that sort of decision allows the liquidators to come after the director and say, okay, you've caused the company loss because it's just under 20k short of where it should be. Preferences. Now, this is if I've got 5 creditors. One of them is the bank, who I just don't like. One of them is a bunch of suppliers, and I quite like them. But another one of them is a loan that I need to repay to my great-grandmother. Now, technically, she is a creditor. And I decide, rather than pay the bank's monthly repayment, I decide to make a payment to my grandmother for the loan. That's me preferring a payment to grandma rather than the bank or any other supplier. And the problem with that is, once the liquidators come in and say, well, what assets does the company have? The principle that they apply is to say, well, everyone gets a fair proportion. If there's only half enough to cover the debts, everyone gets 50p on the pound. And if great grandma's got 100% of her repayment back, then she's in a better position compared to one of the other suppliers who might now only get 5p on the pound. So that just sort of makes you think, okay, when I'm making these repayments, is it the right time? Is someone going to look at this and say, I prefer her over him, or vice versa?
And this is what, thank you, Simon. This is where you get the term preferential creditor.
Exactly. Yeah.
This is what you hear bandied around a lot, like preferential creditors. So it's very important, everyone, that you understand what this. Like I said, this is only really if you're in a situation of insolvency, right?
Yeah.
You're getting to that stage. So yeah, you can't give someone preference. And just to be clear, Simon, so when you say reviewable transactions, what do you mean by that? And also then what does disqualification look like as well?
Well, by a reviewable transaction, it's anything the company has done. It might be a payment that it's made. It might be a loan that it's written off. It could be any sort of decision that it's made that has a consequence. And if I'm looking into what a business has done, I might think, well, okay, there's been a decision here to write off a loan. And the loan would have meant the company had the ability to recover some money. And if actually, because that loan's been written off, the company can't now recover that money, it's in a worse position. So it's a transaction that we look at that gets reviewed. I suppose it's just a way of saying what the liquidators or the administrators look at. Disqualification. Now the CDDA is the Company Directors Disqualification Act. And this is relevant because if the liquidators, let's say, of a company that's gone under, are looking at everything the company's done, they're required by law to make a report on any areas where they think there has been conduct by the director that would result in a disqualification of that person. And these reports get made all the time, often very early in the process. And what happens is, once the liquidation is concluded, part of the government, the Insolvency Service, an arm of the government, comes in and says, okay, we're now going to re-investigate and we're going to decide whether or not, quite often, the same issues the liquidators have picked up with the directors that might have resulted in a monetary payment by the directors back to the company, can also be used to strike off those directors. And it's just effectively a second bite of the cherry that people often don't realize is coming. And because what you do when you are faced with a claim by a liquidator also gets looked at later down the line, it's worth thinking, okay, there's two risks here, not just me being sued personally for money, but actually me not being able to be a director, which obviously has a knock-on effect. Clearly, you can trade without being a company, but for some people that will have a big implication. So,
well, I think, and thank you for, I think it's absolutely like, it's one thing to have to pay some money back or get a fine or, you know, potentially go through court and all that stuff. It's another thing to not be allowed to be a director. And it's like, you know, why would you ever put yourself in that situation or even close to it? And does disqualification, what does that look like in practice? Is it normally, just out of interest, is it normally for a period of time? Is it for life? Is it?
Yeah, it's for a period of time. There is usually a trial. So there'll be some allegations made about what the conduct is. There might be a defense that you put in and say, actually, no, I didn't do that, I did this, or no, I didn't do any of it. If you succeed at trial, then obviously nothing happens, you get some of your money back. But if you don't, or if you decide to accept an undertaking not to be, a director for a particular period of time, that's an order is made in that sort of way. It can be anything from a year up to 12 years, but I think there's scope for it to be longer depending on the process. Most often, it depends on a number of things. And quite often when you're trying to negotiate a lower period of disqualification, you're trying to say, well, okay, this happened, but actually it wasn't as serious as you say. And there's also ways in which you can apply to court to act effectively as a director, even though you're disqualified, by saying, look, okay, this happened, that company went insolvent, the cause of the insolvency was, this particular issue. I'm asking for the court's permission to allow me to keep doing my job. And I'm going to, let's say, employ a specific finance director to help me manage this risk. And that will protect the public from, you know, any particular loss of that company while I'm at the helm.
That's really good to know. I think the other thing, the consideration now, you know, we're obviously property entrepreneurs, and I think, well, effectively always now it seems to be, not always, but most of the time it seems to be preferential to buy properties now in limited companies. So, you know, it's one thing, like, it's yeah, if you suddenly can't be a director and you've got 10 houses in 10 limited companies, you know, there's big knock-on effects. So yeah. I think it's just knowing the...
It is, and again, I don't want, the purpose of today isn't to suddenly alarm people with all these potential risks. There are, whenever you set out with a commercial enterprise, you know, you accept a degree of risk, and the idea here is just to signpost these potential areas to help you avoid them. It's not, you know, for you guys to think, oh my goodness, you know, this is problematic.
Absolutely.
For most people, this does not become an issue, but when it does, it becomes a significant issue. So the idea is to just, you know, can I touch on loans and dividends briefly?
Please, I think that's definitely one for everyone.
Because
we've had a question about loans already, so yeah, I'll ask that after.
Okay, good stuff. Dividends are, I think, the most common way of taking money out of the business lawfully. It's important to understand the framework in which we can properly take dividends, because many of us will talk to our accountants about how we're going to structure our remuneration. And it's very, very common for small businesses to say, well, okay, I don't want to pay lots of tax on my my salary, so I'm going to keep that really low, and I'm going to take money out as a dividend because there's a lower tax on that, and that's really what I'm going to treat as my income. Now that makes great tax sense, but it's important to realize that there are only normally 2 points in time during the company's year that you can take out dividends lawfully. One is at the 6 monthly accounts, and one is its end of year accounts. There are exceptions to that, but then I don't think they're relevant for the purpose of today's talk. What I see often is very small businesses who've actually taken money monthly, chunk of money out per month, and they've said, it's my monthly dividend. And at the end of the year, the accountant gets them all together and says, okay, company's made this much money per year, so I'm treating all these, you know, 5k dividends per month, whatever it is, as one lump, and you know, we're charging tax on those, and we wrap it up that way. That's fine from an accounting perspective, and when the business is doing well, there's probably nothing that will happen as a result of doing it that way. But the moment the business starts to go into difficulty, we need to realize that any dividend that's been taken outside the sort of end of year or 6 monthly accounts is vulnerable to recovery as an unlawful dividend by liquidators. And that can have a big financial implication, because, you know, all of a sudden you've taken a chunk of money out of the business, but actually they might be looking back over, you know, 4, 5, 6 years and say, well, all of these dividends are unlawful and they're automatically repayable to the business. So as a tax efficient way of going ahead, yes, it makes sense, but you also just need to be aware that there's a risk with that framework. Sometimes it's unavoidable, but if you're going to do it, you need to be aware of the risk. And I think the safest way is to declare dividends with the benefit of accounts, because that way you can satisfy the Companies Act requirements. You can say, well, I've prepared some accounts. Here they are. They're the 6 monthly accounts. I can see exactly what the company's done. I can see that it's in a position to pay a dividend, and that's what I've done. And it goes back to taking money out and recording what's on your personal ledger and actually what's on the company's personal ledger. Because if you take your remuneration out of the business lawfully, obviously it goes into your hands. There's probably a tax consequence, but it's less at risk. If you take it out in another way, it can cause you real problems if the company goes into a difficult situation. If it doesn't, nobody might find out and you might be that much better off, but you've taken a risk by doing it.
Simon, I think this this was definitely going to be one of my questions, because I think this is relevant for everyone. And I think the main sentiment here is, if the business has made a profit and you can prove it's made a profit, then you should be able to deliver issue a dividend. Where people
at the right time, yeah,
exactly. So what Simon's really saying, team, is, and he suggested 6 monthly and annually, because at that point you've made a profit. You've got management accounts and you've seen it. And I've heard various views on this. Simon, I've heard some people say as long as you've got good management accounts monthly, you sort of can do it monthly. But I think the sentiment is, and I'd love to know what you think about that, but just so the team knows, guys, don't be issuing dividends as wages when you don't necessarily know you've made a profit, because that is wrong. It's just, if you're very profitable and you can prove you're profitable, then you can issue dividends. But if you're not and you're just trying to save tax, it's probably not the wisest thing to do. So.
The big problem we come across is that the Companies Act, the legislation, is very, very narrow in what it defines as a lawful dividend. It's very specific, and it says that anything that's not your statutory 6 monthly or end of year accounts, generally speaking, it is unlawful. So even though we might say, okay, I've done management accounts every month, I'm in a position to make an informed, sensible decision on what the company can afford to pay me. I wouldn't dispute that. You probably are in a very informed position to make that decision. The problem is it doesn't satisfy the criteria for a lawful dividend, and it doesn't make it any less unrecoverable than something else. So we just need to be a little bit careful. It's a good question, because it's the sort of thing that I'm asked a lot, and it can be very difficult to argue against. And there's obviously a balance here, because sometimes you need to make an informed decision and you need to take a view. But this is about risk. And if all your eggs are in one basket, if all you've done is take payments, by sort of unlawful dividends on a monthly basis for X number of years, then it's very high risk. But if you're able to say, well, okay, I need to take some money out this way, can it be a loan? Can we sort of deal with it in a different way? Can we put most of that remuneration via a dividend at the end of the year? These sorts of questions, I think, are the ones you want to be asking yourselves.
Really valuable. Thank you. Yeah, really valuable.
Okay. I was going to say, in relation to loans that you have as directors, if you borrow money from the company, it's repayable. Sometimes you can write those off, but if you're in a difficult situation, someone else takes over the helm of the business, then those sorts of things are going to be looked at. So very, very common for directors' loans to be used. Very, very common for them to be repaid, every year or however it's dealt with. Just be aware it's a loan, not a bank account. And I say that because experience has taught me that not everyone appreciates the distinction. I'm sure I'm talking to lots of people who may well be smiling, saying, I understand that. But I say it anyway. The last bit was some practical guidance. I'm conscious of time, and I'm also conscious that there may be some specific questions. So, Adam, can I be guided by you on what you?
I think everyone's enjoying the content, so I think we can provided you're okay for time, we can definitely sort of. I definitely want to know about B&O insurance. I've got a couple of questions. So if you're okay for time, we'll crack on.
Yep.
Right?
No problem. No problem.
Cool. Thank you.
So this we're in a funny period of time, really. I suspect we may well end up in recession territory. That is a negative for some people. Other people think, well, fantastic. This breeds significant opportunities, and I'm going to capitalize on that. Property market's going to pick up. There's going to be people who are desperate to move things. There's deals to be done. So you get very, very different views. But I think what we're looking at is just risk avoidance here. A lot of the risks we've talked about, things like misfeasance, things like wrongful trading, things like director disqualification, you can protect against to a certain degree by taking out what's called directors and officer liability insurance, DNOL insurance. It's worth looking at that there are lots of different insurance providers. You would need to pay a premium in the way that you would for your house insurance or contents insurance, and the policies cover different things, but a lot of them can offer some protection because they can pay the costs associated with fighting some of these claims. So I just want to make you aware of that. The second thing is, when you're making decisions on behalf of the business, evidence them. Now, that might be obvious, and you might think, well, there are some decisions that I make. Do I pay this supplier? Do I pay that supplier? Or do I don't know, merge my business with someone else's? Some decisions are more significant than others. Any decision that you make on behalf of the company, I think you need to be thinking of as one that could be questioned. What would an auditor say if someone said, well, why did you make that decision? So if you are going to pay a dividend, you would put in the minutes, having looked at the company's end of year accounts, satisfied ourselves that there were sufficient reserves, and identified that we've made a profit and that the future looks good, all that good juicy stuff. This is why we're paying a dividend, and this is the amount. And it all looks sensible and defensible in the event that someone was to question it. So just think about that. And I think the more significant the decision, if we're going to write off a loan and business is booming, then it's probably lower risk. If we're going to write off a loan and we're struggling for cash flow, then it's a high risk situation. And it might be that you have to do it. So we just need to say, well, okay, how are we going to do it in the safest possible way? So that is a decision that would have a significant impact. So let's be very clear about why we're doing it, because it will be looked at in the context of how responsible was this director in making that decision. And
Simon, I think this is a thing that, this is, you said board minutes, and that is definitely the way to record these things, right? Just to write a simple minute to yourself, like, we've made 100,000 profit in this year, we're going to issue a £80,000 dividend. That's all it needs to be, right? It just needs to be written, dated, put in a minute book, saved on a Google Drive, whatever it is. So you've kept the records. We've decided to sell this asset to this person, and the value was determined at this because we had 3 valuations. That's it. They just need to be short little paragraphs that just neatly sum up what was done, right? Yeah. And if you have accountants that are advising companies, then they can often help you put together these things. Great advice. Certainly, or talk to lawyers, whoever. But I'm sure there's lots of draft minutes that you can pull off the internet. Some of them are suitable, some not. But I think the sentiments are right. Great advice. And I'll just share something on the director's insurance. That doesn't have to be super expensive. And Paul from Coversure in our group, guys and girls, he he can definitely quote you on that. So if you want to get it or you haven't got it, I know he can quote on it, quoted me, and you can get it online and things like that. So yeah, again, like depending on how big your business is and what you think your liabilities are. And for me as well, I don't know if Simon, you want to speak something about this, but directors insurance can be more relevant when there's multiple parties running a company because you're all kind of joint and severally liable. Is that right? So it might be more appropriate if you don't have complete control of the business, or like perhaps it's a bigger business, that it may be more relevant. Not necessarily everyone here, if you're just a one-man band, necessarily needs to go and get it. So
yeah, I think it's a question of risk, isn't it? And if you are one of 5 directors, then you're going to have a say in what the company does, but ultimately you might be outvoted. And I suppose there's a risk of loss of control, and that might make you more cautious and say, okay, I'm a bit more interested in protecting myself. But I think the same applies if you're a relatively novice director, because there will be areas where you come across that are risks that you haven't dealt with, and I think that probably increases your sort of risk profile. It's a decision for everyone to take themselves, really. Some people don't buy home insurance and they just save in a pot of money on the side. Some people are just quite bullish. But all I'm saying is, that this is a possible means of helping that situation. And I think, give it some thought.
Very good. Yeah, I agree.
Rectifying obvious issues. This isn't something that we touched on in the director's duties section, and I don't think it's something we need to touch on significantly now. There is scope where there is, for example, a conflict of interest, to ratify, and that's a technical term that just means approve, a pre-existing breach of director's duties. Now, the circumstances in which that applies can be a little bit involved, but I raise it only to flag it as an area that you might say, okay, I think this is a conflict of interest, but I want to do it anyway. How can I do it in the most cost-effective way? That might be a circumstance where you want to say, okay, I'm going to take some advice here, and you might have a little more help putting together a board minute that says, I'm going to do this. We recognise it's a risk, a conflict of interest, but we're ratifying the technical breach. Or you might say, okay, I've done this already. Having listened to this talk, I now realise there are a number of directors' duties breaches that have taken place. And I want to make sure that some of these are not problems going forward. Sometimes those breaches can be ratified. So the board can get together and say, all right, this has happened, but it's okay. The company doesn't have a claim, sort of thing. So just flagging that as something that's worth highlighting. Being aware of your duty to creditors is the key thing, really. The fact that issues can arise is, I think, the most important piece of knowledge to take away, because it gives you an idea of where the road bumps are. If you're going to inject funds, I say do so early. I don't mean inject funds early, but that might help. I mean take advice early. If you are putting in capital, think about the personal guarantee. Is this going to last for a long time? Can I get out of it? Is there a ready means of saying to the bank, all right, 5 years on, here are our accounts. We're now in a much different position. You didn't like us enough to loan us without the PG before, but I think you must do now. Let's get rid of it. Don't leave this stuff sitting in a drawer. Equally, if the company is in cash flow difficulties, often it's appropriate to put in some funds to try and ease things through. Just be aware that if you put money in at that stage, it doesn't mean that you can take it out.
Sound advice.
We always have problems. Yeah.
Sound advice. Yeah.
Yeah.
And just because you've put it in, but if you put it in last, can you get it out first?
Well, exactly. No, you put the money in last. All you've done is top up the company's pot of assets. But as soon as you take it out, you take away a chunk of money that the company then had. You know, you might think that's massively unfair, and you know, on the one hand, it is. But the idea is that the company's assets are protected. So if you give the company more assets, as soon as you start divvying them away, you create a problem. So if you're going to inject funds,
get advice.
Yeah, get advice.
Yeah.
There's ways of doing it in a sort of more efficient way. Assume you'll be challenged. I don't suggest going through your sort of commercial lives just thinking I'm going to be challenged at every sort of corner, but just have in your mind that this is how things could work, and just be aware of them. And if things start to get a little bit hairy, then you know that that's the time, rather than waiting 6 weeks and putting in a bit of money and not doing anything and finding the business is in a worst case, have a chat with someone sooner, because you can head these things off at the pass. The last bit is WUP is a winding up petition. Now, what we're talking about here is angry suppliers. Now, if you've not paid someone and they've sent you a letter saying, you owe us the money, pay it within 7 days, and you don't, and maybe they send you what's called a statutory demand, which is a formal request for payment, and then you don't pay, they can say, right, we are going to wind up your company if you don't pay. And if they go ahead, then it all goes to court, and it's very difficult to challenge. So don't ignore things that get dumped at the company's registered office, requests for payment. There are steps that you can take to try and mitigate those things. You can fight these sorts of petitions. You can apply to court to validate preferential payments, to allow particular suppliers to be made, all that stuff. Just don't ignore it. We have the biggest problems when we're instructed right at the last minute, because there's sort of limited things you can do and limited time to do them. So those, I think, are the headlines. It's probably also worth just having probably 5 minutes on bounce back loans and business interruption loans.
You've literally just beaten it. Neil's just asked that exact question. So yeah, I'd love to know. I'd love to know how we're sort of personally liable, how you see it playing out, because that's definitely a topic of conversation. And I've got a few other questions for you. So thank you, Simon, for that. And yeah, the sentiment just on that generally, that last point is, we ask our property entrepreneurs, do not put your head in the sand. And I think that's why I wanted to do this interview so much, because we're all in this together, and we want this to be the making of us, not the breaking of us. You talked about seeing the opportunity. We're talking about the entrepreneur's playground, a recession. This is the time of the capitalists. But that said, if you are having difficult times, you've got to know where to go for advice. Don't put your head in the sand, and don't just think it's going to go away, because it won't, frankly. So yeah, if you could talk about Sybil's and bounce back, that would be brilliant. Maybe the difference between the two for directors, and if people have taken them or thinking of taking them, what that could look like. So
yeah, well, I think the first thing to say is the bounce back loans are relatively new, and they're going to change the way the business interruption loans have been made. As it stands, we've got, I think, 3 options. If you're a business, you can have, if you're a large business, you can have what's called a large business interruption loan. And those are really significant in value. I don't think we're dealing with those. The normal business interruption loan, I think up to 5 million. and I think I'm right in saying that anything up to 250k now doesn't have to be guaranteed personally, but anything above that, the banks have got some discretion. Now, the business bounce back loans are smaller loans, I think anything up to 50,000, and probably all read in the press, these have been introduced because there has been difficulty, so we're told, with people getting the business interruption loans. And I think that difficulty arises from checks the banks are running because the loans are only backed by the government 80% rather than 100%. So we've got, I think, two main options in the normal business interruption loan and the bounce back loan. I'm not in a position or going to try and sort of advise you on which to take. Clearly, if you're in need of finance and it's worth looking at those and looking at them specifically, the big point is that you treat them like any other commercial loan. We've seen quite a lot in the media about how the government is backing these loans and how they're effectively a means to stimulate business, to save businesses. To a degree, I think that's all well and good, but they are still a debt obligation that you as business owners are taking on for companies. And when you take them on, you need to be thinking, what is the chance that this business can repay them? I don't think you go into this thinking this is free money. They're no less repayable than any other commercial loan you get from a high street bank or a funder. And I think there's some scope for confusion when we talk about the loans being government backed or government guaranteed. The way the schemes work generally is that the banks are encouraged to make money available to customers by being told that the government will guarantee those loans to those banks. But that only works after the banks have tried to recover that money from any defaulting debtors. So let's say I take out a bounce back loan, 25k, because I'm struggling for cash flow over the next 3 months, and I think it's a short-term thing, and I think the business is ultimately good for the money, and I think I can, split the payments over the next 5 years, and I think it all looks sensible. I take out the loan, I get the money in, I'm immediately hit with an unexpected payment, or one of my key employers is ill and I can't do what I thought I was going to do, and all of a sudden I can't pay back the loan. Now, the bounce back loans, I know, give you a sort of payment holiday of a year, which gives you some time to sort of cover off those sorts of eventualities. And I think they're interest free for a year afterwards. I think it's 2.5%. But you need to check the specifics of whatever you are looking at with whichever funder you're looking at. If you default, let's say, after a year down the line, the bank will still recover from the company. They will say, right, you owe us whatever is left. I haven't seen the specifics of the terms and conditions of a lot of these loans, and it may be that some of them differ funder by funder, but many of them will be repayable on demand. And that means that the company may find themselves in a position where they have to repay a chunk of money within a period of time. And if they can't, then you're putting the company in a difficult position. So just because the press say this is a government-backed loan, I think doesn't mean you can think this is free money. The bank is protected because if your company goes under and doesn't repay them, that's the point at which they turn around to the government and say, oh, it's a bad debt. You agreed to guarantee us. Can you pay us back that 25k? What it doesn't mean is that Joe Bloggs, the borrower, is directly guaranteed. And that's why I say it's important to think about these things as a commercial investment, really. I know that the economic landscape is very different to what we've seen before, but in a way it's no different to other recessions. It's no different to other periods of economic difficulty. We've got some industries that are doing well and some that are doing poorly. But when you're the custodian of a business, when you're the director in charge, you still need to be thinking what's in the best interest of this company.
Yeah, Simon, such sound advice. I think it's just, lots of our property entrepreneurs have taken the loans, and we've said, obviously hold on to them, don't go spending it if you have taken it, etc. I think the reality is that, like you said, it's not the bit of clarity that you've rightly said is that the bank won't go to the government first. They'll come to the company first, and then they'll go to the government if they can't get it from the company. And that is just something to consider. Now, obviously, a bank's going to get a lot of bad press if it starts winding up companies when it knows it's backed by the government. And Lloyds have actually come out this week, and Dan mentioned it on Monday, and they've said, well, we're not going to wind up the small business owner and call in these loans. And they did a survey that reckoned 43%, I think, were probably going to fail these loans. So it's an interesting one, but nevertheless, it's about risk. You can make your own decisions, ladies and gents, but you must know what you're getting into, right? Because this is the reality. And Simon, that means then that the bank could become your biggest creditor then.
Yeah.
And give you a WUP, a winding up petition, right? If it doesn't like what it's seeing, or it could. I mean, like I said, it probably won't, but
I think you're right. Yeah, there's two angles to all of this when we look at these situations, and you look at the sort of cold hard risk. Yeah, it's a debt obligation. It's a big loan. Am I, as a director, going to be criticised if I've taken out this big obligation and actually, on a sensible analysis, I'm in real trouble already? Have I just worsened the company's position by taking on a big debt that I can't repay? Or am I going to be looked at as someone who's taken advantage of a sensible commercial offering? And what's it going to look like in repayment terms in a year, 2 years time? I think there's a lot to be said for the fact that these are, however we look at it, very cheap loans. And a lot of businesses might say, well, even if I don't need this, you see this in the press. A lot of airlines have taken on very large interruption loans because it's just money that they can get their hands on for far less. So in a sense, they might say, well, what better time to do this? We've got a fair amount in reserves. We don't need it, but suddenly we've been made, this big chunk of capital has been opened up to us that we can use. It's responsible for us to take this out. And I can see the same argument applying across the board, subject to everyone's own business position. And you balance that against the sort of commercial reality, which is exactly right for you to point out. How will the banks look if they start pursuing small businesses in circumstances where they've got a mandate to effectively try and prop up the workforce?
Exactly.
That definitely factors into your risk assessment, but you can't treat it as a guarantee because nothing is certain, and the tide of sort of political views in the press is certainly looking like it's going one way today, but in a year's time, when the interest kicks in, and we're all behind this, do we trust that the banks will take the same view? Will something else be on the front of the headlines? You just don't know. So you balance all these things up.
Sound advice. Any other closing sentences on civils and people? Because I am conscious of time, and we've just got a couple of questions I want to rattle through. Is there any more sentiments on that? Simon, is that Simon?
I don't think there's anything else that I need to run through. There's lots that we could say on these things, but I think it depends on your specifics. The business interruption loans are backed 80%, the bounce back loans are backed 100%. I think it will become clear from what I've said that only really makes a difference to the banks.
That's a nice way of putting it. It only makes a difference to the banks. I think that's a really nice way of putting it, actually. But
yeah,
and the fact that the bank hopefully won't be as perhaps aggressive as it was in the last financial, 2008, 2009, where you hear banks calling in loans left, right, and centre. So you have to think the banks are going to behave better, but you don't know they are. But ultimately, for you as a director, it's almost the same, effectively. So fantastic. Well, honestly, that was we've covered everything that definitely I wanted to cover. So thank you so much. We've had lots of people saying it's great content. So again, very, very glad you joined us, and thanks for putting together such a useful presentation. We've got 3 questions. So number 1 is, are there any health and safety obligations for directors? Any health and safety liability for shareholders, sorry, i.e. to check what their directors are doing. You said they're in the background, they're like investors. Does a shareholder have any skin in the game? Great question, Mo, by the way.
Yeah, the short answer is yes, but it depends on how large your share is as to how much power you can exercise. If you own everything and actually you've just appointed another director to run the business, then you've got a significant amount of power to say, I don't like what you're doing, I'm appointing someone else. If you're a minority director, shareholder, and there's lots of you, then you've got some options to say, okay, I don't like what this company's doing and it's having an impact on my shareholding. But typically you have to go to court to get that sort of remedy. If you're looking specifically at health and safety obligations, then directors have obligations to ensure that the businesses they run, particularly where they employ people, have I forget the specific wording, but the work environment is safe. The Health and Safety Act deals with that in quite some detail. So it's an entirely separate.
Does the shareholder have to check what is the obligation on the shareholder to check the directors doing what they should be doing?
Well, the shareholder's role is not to get involved in management. That the management side of the business, the running of the business sits with the director. The director is accountable. Sorry, have I
lost you briefly there, Simon. So what did you say? Okay. The shareholder's role is? The
shareholder's role is not to run the business. That responsibility sits with the director.
Okay.
So, really, if you've got a statutory director, they are going to be primarily responsible for what the company does and how it complies with its health and safety obligations. But clearly, if a shareholder has power to remove a director and becomes aware that director is not holding their end of the bargain, then they're going to want to do something about it. Sorry, I'm afraid you've frozen. I don't know if that's.
No, you're good. Sorry, I didn't know if it was my internet, so I was just turning my video off. Might just be my face breaking the internet. Happens quite a lot. It's so ugly. So another question from Chris. So if this is a great question. So we talked about intercompany loans.
Yeah.
And it's something I know I've used in my businesses. And you talked about reversible transactions. So if you've written off a loan, an intercompany loan, a number of years previously, could that be potentially reviewed as a reviewable transaction? And how far back could that go? And in normal circumstances, like for example, if you're a healthy, trading, profitable company, is it okay to write off intercompany loans?
Okay. Generally speaking, if a company goes into financial difficulty and let's say it goes into insolvency, liquidators can look back up to 2 years. So from the point in time when the company goes under here, they can look back in time 2 years, and anything that happens in this period, they can criticize, they can review. So if there's been a loan write-off here, they can look at it. That period shortened to 6 months if the transaction is with someone who is effectively unconnected, so an arm's length business transaction. It's a bit difficult to describe what connected and unconnected means, but if you've got someone who you don't know, who is sort of third-party trader, you're probably looking at the 6 month situation. If it's to your great aunt or your wife or your brother or your sister, then it's 2 years. Adam, are you still there?
Yeah. So if it's 2 to 6 years, and 6 months to 6 years, effectively.
6 months to 2 years.
Okay, but after 2 years, it goes away.
It's less likely that there would be scope for anyone to question it, I think is the best way I can put it.
Okay, and who would be best to get advice on that from if that person's particularly worried about that? Would they go to their accountant or would they come to a solicitor?
I think it depends on them. I think they're going to probably want legal advice in relation to the problem. But there are certainly some accountants who are going to be able to say quite a lot about how these things get looked at. But if you want a view on what a liquidator could do, then you're going to want legal advice.
Okay, fantastic. So last question and then we'll wrap up. So from Jackie, so we were talking about the timing of dividends being 6 monthly, annually when you've made a profit. Is there any specifics, timing, advice around taking out a director's loan? So provided you've got, for example, sufficient cash in the bank account, is that enough to say, okay, we're going to give the director a loan? Or is there any guidance around that? Because a lot of people will be using director's loans for sure.
Yeah, I think it's a really good question, and the first thing to say, I think, is that timing is important. There's no criticism, I think, of directors taking out loans from the business. The only thing we need to be aware of is that, are we doing anything that's potentially causing the company to go into insolvency? The company's got 20k left in its coffers, and it's about to go into a trading period where it's going to need that to survive, and you say, okay, I see that that's the landscape, but equally I really need a deposit for this new investment flat, and I'm going to tell the company to make a loan to me. So you leave the company with nothing, you crack on, lovely little investment, great time to do it. Then the business is in difficulty. That you have, whether you intended to or not, caused the company to go into insolvency, and that circumstance is going to be criticised. So it's not so much about the fact that it's a director's loan; it's the fact that you've deprived the company of operating capital that's caused it to be in difficulty. So think about the timing, think about the position that you're leaving the company in, and I think make sure that you you explain the circumstances in a board minute or a meeting minute that says, this is why I think it's okay.
Thank you. And I think the follow-up from Jackie, just I've seen on the chat as you were sort of answering that question, was the other way round. So if you've lent money to the business as a person, and I know you sort of covered this, and
I see,
and then you want it back.
Yeah.
Are you okay to have I think the answer to that question is, my understanding is you're okay to ask for it back, provided you're not in an insolvency situation. The moment you are, you just get treated like any other creditor. So the time to do it would be ahead of time, and potentially to get advice to check you're okay to do it.
I think that's exactly right. If you're concerned about depriving the company of capital, but you also want to repay the loan, is there a way that you can make structured repayments, the lower amounts of money over periods of time, gives you a means by which to say, look, I was thinking about the company's cash flow. It might be that you just had a bumpy year and you're in a great position to make the repayment to yourself, in which case, go ahead and explain it. I think that's probably
very good. Yeah, no, I think that's right. I think just depending on your state of your business, if you're not sure, get advice. And the accountant's probably a good place to start. And then depends on the size of the business, depends on the risks, all of it. So very good. Okay, and well, Simon, it's been really great. Thank you. And Jackie just said thank you for that. How can people contact you if they want to get hold of you? What's the best way to get in touch?
Other
questions, like that.
Well, they're very welcome to send me an email. Were I more organised, I could screen share my contact details, but I've cut them off. So I've cut them off. Apologies.
If you send me your email, if you say it now, if you said I'll put it on our Facebook group and stuff, so people have got it as a reference. But obviously, BP Collins is your firm, so I'm sure if they Google you, they'll see lots about you. So
yeah, there we go. Right. Simon Carrol at bpcollins.co.uk. Feel free to Google the firm. There's lots of information, sort of news, updates, all that jazz. But yeah, if you've got questions and want to raise specific things with me, then feel free. I'll try and come back to you as quickly as I can.
Thank you.
Otherwise, thank you for having me, Adam, and thank you all for listening. I've gone on far longer than I expected, so apologies. I hope you.
We have, but it's honestly, it's been super high value. We're getting lots of thank yous coming through, and you've helped me over the years, and I'm sure now everyone can benefit from that same help and guidance. So, guys, if you are thinking of reaching out to Simon, like I say, he's definitely got a personal, professional recommendation from me. So, yeah, I'm glad everyone's enjoyed it. Simon, thank you once again. Like 2 hours of your time, we're very blessed, very grateful. No doubt you're not off to court this afternoon, are you? Is court resumed yet, or is it was not? How's that working?
A lot of it's virtual.
Is it?
So, yeah.
Will you be putting the wig on this afternoon, or will you be?
No wigs being worn this afternoon. It's very warm, so I'm quite relieved, frankly. Yeah.
Very good. Well, we'll let you get back to your business. Thanks once again. Thanks from all of us. Thank you, everyone. We'll see you on Friday at 11 a.m. for Keep Calm and Carry On. So don't miss us, Dan and I, on Friday. So have a great rest of your week. Cheerio, Simon. Thank you, everyone. Thanks for your feedback. Cheers, guys. Cheers, Simon.